It is the South Korean markets that are leading the losses this morning.
We can make Maharashtra the first trillion-dollar subnational economy of India.
Resistance comes in at 25,125 for the Nifty.
It's expecting a flat volumes and mid-single-digit sales growth for quarter 3.
We don't know what transpired, but we knew he was in Delhi.
0.16 lower on the Nifty, 26,644, 642.
We have kind of, been largely revolving and centering ourselves around the consumer discretionary space up until now.
We get access to about 40 plus OEMs and we get access to about 200 plus distributors.
TV's Lab, Newland, Piramal Pharma under pressure today. Why? Because now the US Biosecure Act, that was actually dropped out of the US defense bill.
The sensex lower by close to about 180 points at 11 o'clock.
सरकार एक के बाद एक कई फैसले ले रही है.
This quarter so far has been turning out to be great for us compared to last quarter and also last year, quarter 3.
Markets have come off from the highs, and that's courtesy Bank Nifty. The Nifty is down 40 points. The Bank Nifty, which was up more than around 200 points at a point in time, is just up 81. So the volatility continues, but it's a lot of stock-specific action today.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
$80 points lower, that's the rate on the Nifty right now, which basically means we are where the Nifty was at about 10:20 this morning. It's been sideways from the word go. This is Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant, with me, my colleague Surabhi and Reema here in the studios, and Nigel is joining in from the newsroom. Guys, hi, good afternoon.
Good afternoon.
Good afternoon. Quiet day, but that hasn't stopped stocks from doing their thing, right? I mean, look at CAT. We'll talk about it as we go forward. Right now, I thought I'm seeing something wrong, but no, it's a 15% surge on that one, guys.
That is amazing. And by the way, as you say, Surabhi, it's the day's high then.
Yeah.
15% means, it's the day's high. I saw it up 10, 11, 12%. So there is another fresh leg higher, which has come through. So the market really seems to like what they've done with that acquisition of sort of a premium brand and from Michelin. So that is the news which has triggered this up move. And of course, we have the management with us. We'll get to it in just a bit from now. But for the overall market, it's a little sideways, as I said. It's been that way since the morning. Although there were some bounces, but you're basically back at about early morning levels. Supports come in at about 24,454. Some distance from where we are now. And of course, for the Bank Nifty, that number is 52,961. This is the 40-hourly exponential average. And FMCG as a pack is down 2%, 2.5%. And autos, so Maruti, Tata Motors, Mahindra were the top 3 gainers on the Nifty. It's a reversal today. The auto index is down about 0.6%. Reema.
Well, the story is in the FMCG names. Godrej Consumer Products. Okay.
Oh, I think there's a bit of an audio issue over there. We'll come to it. Yeah, actually, Reema, I'm absolutely with you on that. FMCG has been the story, but for the wrong reasons, because of that howler of a mid-quarter update coming in from Godrej Consumer. It's taken the entire index kind of down with it. There's some global action that we have to track as well, but I think, Reema, your audio is back on, so take it away.
Let's check if the audio is back on. But I was saying it's not just GCPL, right? GCPL flagged off inflationary conditions in the soap business. Also, the entire demand environment has been subdued because of weather conditions in north, south, etc. So Godrej Consumer has taken a big hit of close to about 10%. But in the frontline pack, HUL, Tata Consumer, Marico is down nearly 5%. So this consumption basket is one of the big stories of the day from a market point of view in terms of themes.
Yeah, and we will discuss it with our guests. Whether this is a fresh leg down, if it's just a one-day, disappointment playing out across stocks, or if this is speaking of a deeper malaise within the FMCG basket. We'll talk about it as we go along. Global markets. Now, very quickly, all of Europe is trading with a nice deep shade of green, actually. The CAC is up almost 1%. The DAX is up, slightly. The FTSE is up. So European markets are, starting the week on an optimistic note. The interesting news comes in from our neighborhood, from China. The Hong Kong market, by the way, has closed about 3% higher. Yeah, almost 3% higher. The mainland Chinese market didn't react too much, but Hong Kong got very excited. And why is that? Because there's some talk about perhaps looser monetary policy in China come next year. And this is not just talk, actually. What's happening is that these are statements that are coming in after the Politburo meeting in China. Now, what do the statements say? They were in Chinese and CNBC's translated them, and what I'm telling you is a translated version. So China is talking about more proactive fiscal measures and promising moderately looser monetary policy in 2025. And it's the first time since 2011 that they're talking about this moderately loose monetary policy. This got the market really excited. The news came out, I think, the last 1 hour of the Hong Kong market trading, and therefore the market managed to move higher. Now, remember, later this week is the other important meeting, this annual Central Economic Work Conference. And the expectation is that we'll have some more clarity on these stimulus measures. So maybe, once again, hoping for a Chinese stimulus. So that's the big international headline. Nigel.
Okay, all right. Got that. Surbhi, well, just two more stocks I want to point out. Zaggle, just pull up the chart out there. You know, that stock has been moving very, very well. So the intraday chart comes out for you. And Protein E-Govern, you know, that's the other stock that I'm looking at. Just pull up the intraday chart on that one as well. They had that large, OFS that took place from the NSE. And that's out of the way. So both these two, they've got a bit of a tailwind as well with regard to the industry they're in. And both of them currently at the high point of the day. Well, let's focus on the stock of the day, though, on the downside. Godrej Consumer, that slipped after the company released a weak mid-quarter update. Mangalam joins us to run us through the fine print and what it means for the industry as well. Mangalam.
Well, two things that it means for the industry. Godrej Consumer's mid-quarter update is that, one, demand conditions are still subdued, and secondly, raw material price pressure, especially on the palm oil prices front, increases. So palm oil prices are higher by about 20 to 30%, and as a result of which, Godrej Consumer's own soap business has taken a bit of a dip. Why is that? Because the companies are either reducing their grammage or increasing their prices. With the kind of inventory that is there at the dealers already, and the quick commerce doing well, means that there is not enough, offtake as well from the dealers. So all of this implies that volumes for Godrej this time around would be flat with a mid-single digit sort of revenue growth as well, which is much lower than the company's own anticipation of high single-digit volume in the second half, which they had downgraded in the previous quarter itself. The other part of their portfolio, household insecticides, was impacted by delayed winter in North India. It's a seasonal product. And add to all of this, the environment is competitive. Last year, same quarter, the company had reported abnormally high margins as well, which they alluded to as well. So all of that means that the bottom line will also be impacted because there would be sharp margin decline as the company continues to invest in marketing. What does this mean for other consumer companies? One, demand is weak, and secondly, raw material prices are high. But could there be a lesser impact than Godrej on something like an HUL? Because HUL had already said that there could be some bit of price increase and they hope to maintain their margins. But this was at the end of the second quarter. The question is, have things changed in the third quarter as well? With palm oil prices increasing, there could be an impact on all other food players as well, which use that as an ingredient. So all those things are what we'll watch out for, especially in the third quarter, which is supposed to be a seasonally strong quarter. Could there be recovery here, or could there be an impact here on which rests the great Indian consumer story, at least for the next couple of quarters?
Right. Mangalam, thank you very much for that. Let's get both a technical and then a fundamental perspective on FMCG as a pack. Mitesh is with us. Mitesh, good afternoon. You heard Mangalam, we were talking FMCG. The index is down 2. So why don't you start with the Nifty first, your trades, and then a quick view on what you're seeing here in the FMCG space.
So, good afternoon, Prashant. I think, the Nifty, as I've said, will be consolidating between broadly 24,500, 24,800, and therefore, buying should be attempted around 24,540. Today, we got a low of around 24,595. I think that's the way it's positioned. I think, not much of a movement, mild kind of pullback. But as long as we don't break this 24,500, 450 zone, I think, we will eventually again pick up. Let's not forget that in the last 5 days of pullback, Nifty rallied from 23,800 to about 24,800. So it might take a breather here, a few days of sideways activity, and will maintain a positive bias. The Nifty FMCG index, particularly has seen a big decline, and most of the stocks in short-term patterns are looking bad. In fact, Dabur is something, which I can recommend even a sell. I would recommend here selling with a stop just above levels of 513. Look at a target of around 490 here. So the broad idea is that this is not the best time to get into FMCG because it's available slightly cheaper than yesterday, I think there could be slightly more damage in the next few days. So I would be slightly patient. And Dabur is something, which I've already mentioned. The other one is a buy on delivery. I think that's recovered in the last 2 days. So keep a stop at about 364. Look for this bounce back to extend to about levels of 390, 395.
Okay, all right, got that. Thanks very much, Mitesh, for all the trading calls. We also have Dipan Mehta with us, and let's actually start that conversation on FMCG itself. Dipan, hi, great to have you on the show as always. This is a bit of a disappointment, or maybe a larger than a small bit of a disappointment from Godrej. Do you think the market's concern today is warranted, the kind of stock price reactions that we are seeing, or do you find it to be a bit excessive?
Good afternoon, Surbi, and thank you for having me on your show. See, I think there was a fresh trigger for selling in the FMCG stocks with what Godrej Consumer reported. But if you go back last 4 or 5 years, even longer, FMCG has been underperforming. And the reason for that is that a lot of categories have reached maturity stage. Their growth rates, volume growth rates are in low single digit. And there's a lot of competition. It's a red ocean over there. And therefore, they're not able to increase prices as well. Occasionally, because of lower raw material costs, they're able to get some growth in earnings. If you go back last several quarters, an FMCG company has done well only when raw material prices have come down or they have cut down on advertising spends. And the minute those start to normalize, we see almost stagnant to flat profit. Now, of course, it's a great cash cow. The cash flows are strong, return ratios are great, but there is no growth. And when there is no growth, I think investors are bound to avoid it. So I would say that even at these levels, it is a good idea to exit out of all FMCG stocks, be it Indian FMCG or for that matter, even the MNC FMCG companies.
Okay, exit all FMCG. That's the big statement coming in from Dipan. Let's move on now to CEAT. That's a big mover. This is as the company is all set to acquire Michelin's Camso brand. Now, this is an all-cash deal. It will be completed within the next 6 to 9 months. Sudarshan joins in with what brokerages are making of this transaction.
So in a subdued market, one stock that has surged is CEAT, which has moved higher up to 15% in today's trade. So what's the talking basic deal basics? First deal is of $225 million. It's an all-cash deal. Company is acquiring Camso brand, which is into off-highway trucks and tracks business of Michelin Group. Now, what's positive? First, it will add revenue of $213 million to CEAT, and company sees potential revenue increasing it to $250 million. And second, margin of the company that CEAT is acquiring is in the range of 15 to 16% against CEAT's margin of 11 to 12%. So here also there might be an uptake. Third, debt to form 70% of the funding. Debt to equity ratio currently stands at 0.4 times. After this deal, it might increase to 0.7 times. That also company believes it will be in the comfortable level, and there is no plan to raise equity at this point. Most of the brokerages are positive on the stock. Investec has a buy call with a target of ₹37.50 per share. It says it's a step in the right direction, and CEAT remains preferred pick in the sector. Second is Nomura. It has a neutral call and target is with 3,051 per share. It says attractive valuation can drive up to 10% EPS accretion. And second, Camso segments are niche and long-term growth potential by the acquisition may be modest. So overall, it's positive for CEAT.
Okay, thank you very much for that. Big thumbs up by the markets today. Now, earlier today, we had a chat with Anand Goenka, Vice Chairman at CEAT. Listen in to excerpts from that conversation.
In today's world, getting access to high quality premium brands is a rarity. Getting customer access in EU and US, particularly with high quality OEMs, high quality tractor manufacturers, compact construction makers, and distributors gives us a great entry and stronger position in these markets. We get access to about 40 plus OEMs, and we get access to about 200 plus distributors, and this is at the high-end premium segment of the market. So to us, this is what is most exciting. Also, the OHT segment is generally higher margin than the routine tires business of passenger car and truck, etc. So this will increase our share in the higher segment business. The larger effects will come in from calendar year 26, say. And with that, I think the industry itself is growing at about, say, between 5 and 7%. If we are able to get the two companies together and integrated well, I think we should see higher growth than that going forward. In terms of margin, the margin profile of the business is at about 15 to 20% range. In CEAT itself, we are at about 11-12% margins. So to that extent, if you were to look at the numbers, about 2,000 crore revenues coming in on a 12,000 crore base. So some uptick on margins is something that can be expected. In terms of margin, yes, Q3, there will continue to be some stress on the margins. Rubber prices went up from about 150, 160 rupees per kg to about 250 kind of levels about 2 months ago. This has cooled down, and at the same time, we've taken some price increases in October and November. So with some of that, we think by Q4, margins should get better. And then the year after that, things should continue to remain fairly positive. And in terms of equity, we don't plan to raise. We feel our balance sheet is fairly strong. We will be in our ratios of debt equity, debt EBITDA, we'll be within fairly comfortable numbers even after the acquisition.
Okay, so that was CEAT, the management there, talking about why this acquisition from Michelin makes sense for them for the off-highway business, tires and tracks business. Deepan, I wonder if you caught a bit of the management commentary. And then again, I mean, here the market's extremely excited. It's the exact reversal in terms of market reaction to a Godrej. Here there is so much of euphoria, though I must say that Anand did tell us that the company was doing $200 million in revenue, but now this year I think it's dipped below 200 million. They are hopeful of scaling it back to about $250 million annual revenue. And then obviously the margin part is the exciting part, right? Improving margin profile. Your thoughts on CEAT?
Yeah, Subhi, I think it's a very good acquisition for CEAT. And if you look at the entire tire industry, the biggest value creator has been Balakrishna Industries. It trades at premium valuations and has the best growth metrics among the entire tire industry. And now CEAT is trying to get into that. It's going to be a smaller division for them amongst the larger business which they have. But it's got great growth potential. And I think what is happening just now is a re-rating of the P multiple of CEAT Industries. From a typical tire manufacturer for passenger as well as truck, it's now getting into a very niche segment. And it's aggressive management. If they grow that business, who knows, 3 to 5 years or so, it will be a big contributor to the profitability of the company and could take it to the next growth phase. So very positive on this development. And, I would say congratulations to CEAT. I think it's a great acquisition.
Information at the bottom of the screen. Deepan, I think you would have also tracked it, and I think you own the stock, from what I remember, Mapma India. It is flashing right now. They have reversed the decision to making any investment in the new company to be formed by Rohan Verma. Rohan Verma is, he was the MD. He's the MD and CEO of the company. He's also the son of the promoter of the company, and this is what is coming through right now. So they've reversed the decision. The market, of course, did not like the decision one bit, and you can see the reaction up on the screen. But Rima, you've been sort of tracking this, right? When it happened, and of course we spoke
we spoke to the management, and what they said that the earlier decision was to invest 10% into this new B2C company, and they would do this by subscribing to 35 crore worth of CCDs. Then, after the negative feedback from the minority shareholders, in a conversation to CNBC-TV18, he told us that Mapma India the listed entity, will hold 10% in the new entity, but it will not subscribe to the 35 crore worth of CCDs. Now, the question here is, are they referring to not paying that 35 crore for their 10% stake, or are they not even, going to let the listed entity own their 10% in the new entity? Because another grouse by the shareholders was that, fine, you're not, going to be paying for that 10% stake, but the new entity will be allowed to use the branding of Mapples, which is of the listed entity, and you're not paying any royalty. So just awaiting some decision, but clearly the board has taken it, has taken the negative feedback from the minority shareholders, and they have reversed the decision. But as I said, I'm still awaiting clarity whether they're talking about just not paying, getting the 10% for free. 10 lakh rupees is what the management told us, or they're not making the 10%. There is going to be no,
Yeah, I mean,
linkages between the two.
This is the first operational line that we have, and if you go by it, it's very clear. It reverses its decision to make any investment in the new company. On Friday in Editors Roundtable, we had Nilesh Shah of Envision Capital with us. He's an investor, and he's liked the business. He's liked the story of CE Info, earlier. And we asked him this question, that does something like this unsettle you? And he did say that while he's not sort of immediately selling his stock, it is perhaps something that was not in the best interest or the best taste, and the market couldn't understand the rationale that was put forth by the company and by the promoters. So I think investors pretty happy that this decision has been reversed.
I think we can ask Deepan. Deepan is an investor in the
company.
Deepan,
yes. Please tell us, what do you think?
Even I am unsettled. With the. I think they have been very badly advised. If you want to do a retail business from a subsidiary company, you can get private equity over there, and there will be no conflict of interest, and you still have, Rohit Verma helping you out with the main business. I don't understand why they are doing these things. There are so many precedents where Sunrise Industries, which requires a lot of investment and which can create huge losses, is part in a subsidiary company. The market can easily start to value what the core business is without the startup, and it's getting the P multiple. So I don't know why they are doing all this, opening up Pandora's box, in terms of who owns what and what related party transaction takes place. And more importantly, how much of top management time will go into this new company of theirs. End of the day, it's a knowledge business, and you want all the promoters to be focused 100% on where the minority shareholders are holding the company. And this is something, which is not great at all. And it's a small step. They're not investing in it, but I don't understand why it should be a separate company outside of, MapMy India. It's the same thing what these MNCs were doing, start a listed company and then do some business in a 100% unlisted company. That never went down well with the shareholders.
Okay, so just to clarify, there's going to be absolutely no connection between the listed entity and the new B2C company that Rohan Verma was hoping to float. They're not even going to, so MapMy India, the listed entity, will no longer have a 10% holding in the B2C company. So absolutely no linkages between the two. MapMy India will continue to focus on the B2B and B2B2C business. So the entire decision has been reversed, and the shareholders are clearly very, very happy with that. As we slip into a break, we will introduce a growth code, a special. Why don't you take it? I think you're doing this Grow CNBC-TV18 partnership.
No, I mean, it's an interesting one. It's a partnership with Grow, which is now pretty much as large by the number of users, almost as large as Zeros. I've actually, a couple of months back, it exceeded Zeros in terms of number of users. So it's an initiative between Grow and CNBC-TV18. It's designed to provide you with insights and strategies to navigate the market and make informed decisions. This week, CNBC-TV18 sat down with Nilesh Shah, MD and CEO, Kotak Mahindra AMC, to understand what are some of the most obvious mistakes that even great investors tend to make and how to avoid them.
Nilesh, overconfidence is one of the big enemies for investors, because when you know something, you really know it and you want to do everything. What strategies should investors adopt to sort of overcome this, overestimating the probability of their success when making these decisions?
So there is one Gujarati proverb which says, Viswas Vahanne Tare. If you are confident in a storm, then only your ship can come to the port. But there is a very fine line between confidence and overconfidence. How do you remain confident so that you can make money and bet big, and at the same time don't become overconfident? I think you have to keep your eyes and ears open to listen to criticism. My best strategy when we are taking big bet on a stock, I'll call a guy who is bullish on it, I call a guy who is bearish on it. Suniye sabki, kariye apni.
The Outstanding Contribution to Brand India Award recognizes one such leader. Ladies and gentlemen, a huge round of applause for Mrs. Neeta Ambani. Ma'am, your philanthropic leadership has been pivotal in building Brand India, touching millions of lives through Reliance Foundation. Mrs. Neeta Ambani has created a legacy of meaningful change, shaping a global narrative of India as a nation of opportunities and inclusivity. She has positioned the country as one rooted in compassion and innovation. Ladies and gentlemen, once again, a huge round of applause for Mrs. Neeta Ambani, founder and chairperson of Reliance Foundation.
Okay, welcome back. We've got the market recovering a little bit, just a little bit, but not. I mean, it's not a big one. Just put up Map My India. It was up 8%, then it sold off a little bit. Now it's up 12%. So it's spiking once again after giving up some of those gains. In any case, even before this sort of botched up plan to sort of create the separate company, etc., the stock has been in a decline for a while. The high was about 2,800, and it was in any case down to about 1,750 or so before this announcement was made, and then of course it sold off to 1,500 levels, and now it's come back to about 1,840 or so. We have Hari Shamsundar with us, Vice President and Institutional Portfolio Manager, EME India at Franklin Templeton. Hari, good to have you with us here. Good afternoon. Thank you for your time. So give us a sense of what's happening at Franklin. I think your first time here on CNBC, so welcome. And I hope this is the first of many. So give us a sense of what's the thought process, Hari, at Franklin. How are you approaching markets? What's the view overall? Because, I mean, we've done very well. Markets, even with this 10% pullback on the Nifty that we had from the September highs, I mean, things have gotten back pretty quickly. Small cap index last fortnight is up 10%. So where does it leave us?
Just starting with how the year has panned out, in a sense, Prashant. We started the year looking at the entire world going for elections, right? So most of the democratic world is going for elections. And what is remarkable is that the outcome across the entire world has been the same. The incumbents have either been defeated or they've had a weaker mandate. Now, if the voters have voted for change, then I think 2025 sets us up for seeing some of the impact of that change. We're already starting to see some of that playing through. We should expect 2025 to be a bit more noisy. We should expect it to have a lot more noise on the geopolitics side, even on the Indian side. I think we've already seen some of the changes starting to ripple through. So if you look at our markets as well, we started FY25 with the projections that the markets are going to grow by about 15%. That is not going to happen. We are going to be maybe at the high single digits in terms of the earnings growth for the Nifty at least. And I think the reasons for that, if you look at it, have been pretty clear. We are seeing that the government spending has been weaker on the capex side. So for the first half of the year, if you look at it, government capex is down 15% odd, which is left, if you look at the projections which are made in the budget, that's left about maybe a 1.4 lakh crore void in terms of the capex spending. And that's, of course, shown up in the earnings across the board on the consumption side as well, while the government spending there, if you look at it, it's very, very clearly up very sharply, whether it's the agriculture, media, social spending. Across the board, you've seen 30% kind of allocations which have happened, 30% increase in allocations which have happened. And that has supported rural. So you've seen that two-wheelers are up 15% from September to November. You've seen year on year at least, and tractors also showing similar kind of growth. But consumption as a whole hasn't played through because urban has played a bit of a spoil sport. So consumption anyway has not been really the backbone of what this market has been about, right? It's been mostly a investment-driven cycle. And we firmly believe that India is on a multi-year capex cycle on the government side, on the private side, and on the household side. The government's already spoken, and they've already showed up and played the game in terms of increasing the capex sharply. Private has shown signs of the spends picking up. This year the first half has shown some signs of continuation on that, but not maybe at slightly lower pace. Some ripple effects from the government slow spending as well. But real estate, of course, is something which we continue to be positive on as well. So across the board, if you look at it, this has been a market which has really rewarded stock picking. Stock picking is our forte. We are bottom-up stock investors. We have seen a healthy set of stock rotation and sector rotation play out in this entire market. And that's what we continue to expect. Positive on a number of themes related to these sectors, and we're looking forward to
hope to see more of you. So that kind of sets the stage, right? You're still a believer in capex as a house, and you believe there will be a pickup both in government as well as private capex in 2025. So expand on that. and manufacturing, and somewhere throw in a word on autos as well. I mean, you've looked at auto companies in India very, very closely in your earlier avatar as an analyst as well, right? And there's so much moving here. And we were just talking about the FADA data. In the morning, those numbers came out. And look at the pain. The CV pain continues. Passenger vehicles, apart from SUVs, the entry-level segment is not really hitting home. Then there's a whole EV transition. So talk about CapEx and manufacturing. And within that, will autos be a way to play it at all?
Sure. So CapEx itself, now we've got to look at the fundamentals of it, which, as I said, the government second half spending, if they even meet the budgeted numbers, we are talking about a 30% plus year-on-year growth coming through for the entire market. For the government spending. That provides a strong sequential boost to spending, and you could see a lot of noise, or positive noise at least, coming out over the coming months on this particular side. Now, of course, we are also conscious that the valuations in some of these places have been stretched. With the government spends jumping as much as they have in the last 3 to 4 years, some of the stocks had also priced in that in perpetuity, and that was just unsustainable. So not to speak about any stocks directly, but if a stock has gone from 15x to 80x and now is down at 50x, it does not make it necessarily very attractive to invest in. Still, we are still waiting for some of these stocks to get to very attractive levels. We still are positive on the banks. We are positive on the financial sector. I'm playing it through banks. It's a bit boring in the number of times it's been spoken about, but we are things seem to be aligning there for the banking space. On the consumer side, we are the believers in the premiumization story of the Indian markets. Even the auto space, we have seen premiumization play out in its own way. I mean, definitely SUVs are a clear sign of how the Indian market is premiumizing on the auto side. Yes, the FADA data has shown a bit of pain playing through on some of the retail side, but some of this tends to be a bit temporary as well. We have seen urban discretionary, urban income and urban consumption names being impacted, but we think that this is a bit of a temporary lull before it starts picking up again. So while you've seen it do fantastically well, the whole K-shaped recovery was premised on the urban consumption doing very well. Now that seems to have played out, at least in the near term. But the arithmetic of the growth which we are seeing and the per capita kind of growth which we're seeing over the years just points to the fact that this is a space which is just going to continue to play out
Hari,
well in the medium term. Yes.
Yeah, Hari, just to complete the point on CapEx, you said that you're still waiting for some correction in some of these stocks. It's true, right? I mean, a lot of the MNC capital goods makers are still trading at some 75, 80 times. So you're saying you're waiting for correction there. In the meantime, you're playing the CapEx recovery via banks. And is there anything else?
Banks, construction materials, realty. So these are the ways which we are looking to play the CapEx theme. So, I mean, apart from that, consumer services also is something which we are positive on to play the consumption name, whether it is through restaurants and hotels or retail as well. Select parts of retail have been very attractive to invest in.
Hari, I noticed you have Kalyan Jewelers in your portfolio.
Yes.
It's not a quest. I know, I'm sure you can't stock specific names, but across the board, right? I mean, you can rotate out of some of the very expensive names to lesser expensive names. I mean, I just thought of it because PN Guard, there was an initiation report on PN Guard. I mean, trades at 40 times. And of course, I mean, the cheaper ones. And there are others as well, but just your thoughts. It makes sense to do it as you wait?
Just, I mean, without getting again to specific stock names, this point to a couple of important textures of the market itself. One is talking about stock selection, and the second is the formalization as well. So you have seen jewelry names. If you look at the top 15 jewelry names, those have grown much, much faster than the tail end of the jewelry space, right? So I think the data just points to the fact that formalization has been just such a powerful theme which has played out, man. There's no better example of that than the jewelry space itself. You've spoken about a couple of stocks in particular. both of them have been witness to this particular theme playing out. And yeah, I mean, without making any recommendations, it's just pointing to the kind of stocks which are working in this market.
Okay, all right. We'll leave it there, Hari. Thank you very much. And we'll pick up on some of these points in our next one. Thank you for being here on CNBC. We'll take a quick break here. We're going to come back. Nimesh joins us on D Street Chatter and some trading ideas as well. I think there was a brokerage call on Infosys at the bottom of the screen. So we'll address that as well.
The Outstanding Business Leader of the Year. This year, the award goes to the one who has redefined success with unwavering vision and determination. Requesting Mr. Vellayan Subbiah, Executive Vice Chairman, Tube Investments India, and Chairman and Non-Executive Director, Chola Mandalam Investment and Finance, to join us on stage to accept the honor.
A big round of applause for Mr. Subbiah, and many, many congratulations in winning this award. Mr. Subbiah, you've truly raised the bar for leadership, and we'd love to hear your thoughts.
Welcome back. We'll keep an eye on a few stocks. You know, Metropolis is a stock that's moving very, very well in the last few minutes. I think we should get the intraday chart on that one up. And Gravita, it's saw a fair bit of correction from the recent peak. Now, that one as well, you know, as we speak, it's moving higher. And volumes as well picking up on both those two names. So just think the intraday chart makes sense to pull up. But it's that time of the day when Nimesh joins us to help us out with what he's picking up in D Street Chatter. Nimesh, this time around, what do you think with regard to the flows?
Well, Nigel, the Nifty looks weak, but it's largely dragged by a couple of sectors. Overall breadth is still positive. The flows are still positive. The buy-side ratio is close to 2:1 on the buy side. Good. So again, it looks like there is momentum backed by FI buying. So that's overall feedback. Sectors which are dragging are the two obvious names, FMCG on the back of that weak commentary from GCPL, and also the CDMO players because of the disappointment with regards to the Biosecure Act. So these are a few sectors which are dragging. Surprisingly, for the second day running, there is buy flows in the metal names as well. So looks like some bit of interest is back in the metal stocks as well from larger institutions. I guess, the momentum in broader market is clearly visible. The mid-cap index is up and actually is outperforming. And that's where the flow seems to be from larger HNIs as well. So that's one space which looks good for the December series. So that's the overall feedback. I guess from a support point of view, the recent support of 24,300, 24,350 is a level to watch on the downside. But at least in the near term, the feedback is the momentum seems to be in the broader markets, and there is decent FI buying.
Okay, all right. You know, on metals, Nimesh, two factors. One is Mr. Sajjan Jindal has been telling us that they made a solid pitch. So the street is hoping maybe before the end of this calendar year something can come. And the other one is China seems to be stimulating the economy. They are promising for better times yet again in 2025. So let's see how that goes.
But what even for Vedanta within the metal names, there is a trigger of a demerger. So when that's keeping the stock exciting.
Absolutely. You know, and if that demerger comes about, maybe they can sell that steel asset if they get the anti-dumping duty. So everything will be, falling in place for them if that does happen. But tell us, what about individual stocks?
So in terms of individual names, the first stock is Kalpataru Project, Kalpataru Power. Again, the trend of stake sales continue. And when the stock has been consolidating in the range, I understand there's going to be a large block in Kalpataru Projects very soon. So likely the promoter could be a potential seller there. So that's the first name. The second stock is Dynamatics. Again, a mid-cap name, but that's been buzzing off late. This month, the stock is up 10%. So in the last 8 odd days, the stock is rallied 10%. And the indication is that maybe the company is likely to announce an acquisition very soon. It's going to be a domestic acquisition, is what I understand. So again, something to track in Dynamatics there. The third name is Protein e-Govern. This is interesting. Like finally, it has come above the OFS price now, and there is a bit of buying as well from larger HNIs in the last couple of days. So that's the reason why Protein e-Govern is in buzzing of late. And the last is Rain Industries. We saw big traction in that stock on Friday. That momentum seems to continue in today's market as well. The volumes are on the high side. And again, in Rain Industries, there's a feedback. It may be a couple of corporate developments around the corner. So something to track in Rain Industries as well.
All right, Nimesh, thanks very much for that interesting list as always. And we'll keep track of some of these names. Mitesh is with us with what to buy or sell today for a reverse trade tomorrow. Mitesh, what do you have?
Yeah. So, Prashant, the market, has remained on the quieter side. And therefore, I think on the index, as I said, the trade will happen once, we get something near the support levels. But on the stock side, I have a BTST on DMart. I think that's showing some signs of bottoming out, given the fact it's extremely oversold. So we take a very tight stop loss here, 38 online, and a target of around maybe 38.50, 38.55 on the upside for tomorrow. And the other one which I would suggest is SCBT, a BTST on GNFC. It's trading down today, but near the support levels. So keep a stop at about 6.7 for targets of 6.30.
Okay, thank you very much for that. The other big story in the market was the fact that the Biosecure Act was dropped in the US. Remember, CDMO stocks like a Divi's Laboratories, Syngene, Piramal Pharma, they've all been active. There was investor interest in them over the last couple of months on the prospects of Biosecure Act and the opportunity it throws up for the Indian players. But now, at least, it appears that opportunity we'll have to hold off on that opportunity. Vinny is now joining in with the details of this Biosecure Act, which was pulled out of the key defense bill. Vinny.
So absolutely, this is an important development because in September when it was announced, the Biosecure Act coming in, it's a big positive because this act actually says that, the Chinese companies which US innovators are dependent on, that will start seeing a reduction. They want to reduce their weightage in terms of Chinese companies and move towards other countries. So that would benefit Indian CDMO players, and that's why we've seen a run-up coming in for all these stocks, whether you look at a Divi's, Piramal Pharma, Newland Labs, or even a Syngene. Now today, obviously, because the US Biosecure Act was not picked up by the defense bill in this legislation, that is why there's a bit of a concern that came in, and that is why seeing these stocks fall in trade, because in 2024 there are only two opportunities. One of this was over the weekend in the defense bill. The other one is going to be in the fund packaging legislation, where they can maybe put in the bill as well. So that is what we are watching out for now, that whether the US Biosecure Act actually comes into that. Because if that is not clear in 2024, then in 2025 they will have to go through a whole new process, and that will take a bit more long amount of time in terms of the clearance that is coming in for the act and the shift that comes in towards Indian businesses. So that is why a bit of a negative on the sentimental front for these pharma companies.
Okay, thank you very much for that. Let's move on to the other stock which is on our radar, PN Gadgil. This is on the back of a Motilal Oswal report initiating coverage with a buy rating. Mangalam is back with us for more. Mangalam.
Well, so PN Gadgil has been doing well ever since its IPO itself, and the story has been pretty clear that, they are the second largest company in Maharashtra when it comes to the number of jewelry stores, and they are looking to improve their store economics, unit economics on the store, increase the made-to-order sort of proportion coming in their revenue, which is high profit margins, and the third one is studded jewelry itself. Motilal Oswal, understands the same, and now they've initiated coverage. They have a target price of close to around 950 odd rupees. The company has about 48 stores in Maharashtra. They plan to beat the industry leader in Maharashtra, Tanishq, that is over the next couple of years. And those triggers would actually lead to the company's revenues, market share, as well as margins and net profit compounding. As far as studded is concerned, that was nearly 7% of their sales, which has seen an increase of nearly 250 basis points over the last 3 years. The management believes that this could reach double digit in the medium term as well. So those factors doing extremely well for the company, and as a result of which, if you look at Motilal Oswal's own expectations, it's over 20% that they expect the revenues to compound at over the next 3 years, with over 30% compounding for both EBITDA as well as the net profit too. That brings us to the valuation picture. They've ascribed a valuation multiple of 34 to PN Gadgil, and a more comparable company to that would be Senco, because PN is localized in Maharashtra as against Titan or Kalyan, which are national players. Senco again is localized in the eastern part of the country itself. So 30-34 would be a multiple that analysts are ascribing. The interesting thing on that chart, which is on your screen, is the lower half. Remember when Titan was trading at around 60-65 times, Kalyan Jewellers had come out with an IPO. That time it was offered at around 28-29 times. The street was hoping for that gap to narrow. Not only has that narrowed with Titan's underperformance over the last couple of years and Kalyan Jewellers' outperformance, Kalyan Jewellers is currently trading at 68 times as against Titan, which is at 65 times. So both of them expensive, but Kalyan Jewellers actually, on a valuation basis, is more expensive than even Titan.
All right, Mangalam, thank you very much for that. So that's the valuation table there which puts things into perspective. We'll take a quick commercial break here. More market conversation on the other side. Stay tuned.
Promising Company of the Year. And the winner, ladies and gentlemen, please put your hands together, is PI Industries.
Congratulations to Mayank and the entire team of PI Industries.
Well, the market's a little bit lower, nothing too much to worry about. The Nifty Bank more or less flattish with a mild negative bias. Let's get you some market opinion. Earlier today, we spoke to Timothy Moore, the Chief Asia-Pac Equity Strategist and co-head of Asia-Pac Macro Research. Let's listen into excerpts of the conversation we had earlier today.
Be clear, our base case is for the U.S. to impose an additional 20 percentage point increase in tariffs on China and some tariffs on auto exports from Europe to the U.S. and from Mexico to the U.S., but not the across-the-board 10% tariff that had been threatened or raised as one possibility. India is, more of a domestically oriented economy. It's got much more domestic engines, as you well know, and so it may be somewhat affected by that, but certainly not as much as the more globally trade-oriented economies, whether it's China or Japan, Korea, or Taiwan. Those are much more in the crosshairs of that concern. Credit to corporate India for delivering earnings. I think that's really kind of the fundamental upside. Valuation-wise, I think it's a bit harder to argue for significant upside expansion from current levels, which are still 23.5 times forward earnings. That's still on the more elevated side of the range. I'd say the only way you could argue for that would be if the RBI continues to reduce policy rates and we get sort of interest rates coming down, perhaps more than we're expecting, and that could then give a little bit more upside on the valuation front. But I think those would really be fundamentally from an earnings and valuation perspective.
Okay, Nifty target 27,000 and the street. I think the big event today will be the RBI governors, who the next RBI governor will be, or will it be an extension? So the street is awaiting a decision on that. Yeah.
Sorry, no, I'm just, that of course will come, I think, has to come today.
Has to come today,
Take a look at MapMy India, 17%.
Amazing.
It's, I think, a surge to a new high for the day. I was dithering, but MapMy India, CE Info Systems is what we're talking about. Look at that. That's a sharp 17% move.
It's higher now for the fourth day in a row. And when the negative news came out about this investment in B2C without the company paying any royalty, the stock had fallen from levels of 1750. So anyway, in the last 2 days, it surpassed the level at which, the stock started falling. And now it's even climbed up higher, inching towards, crossing the 1900 mark. And the street is happy that they've taken the investor feedback on board and reversed the decision, which they did not like. Moving on now to some corporate opinion now. And this one is coming from Baba Kalyani. He says he's not worried about the slowdown. He's focused on Prime Minister Modi's Viksit Bharat roadmap. This is coming in from the Bharat Fort chairman and MD, Baba Kalyani. He was chatting with Nigel at the IBLA 2024 red carpet. He also spoke about what the company plans to do with the money that they raised via the recent QIP. Listen in.
I won't worry about slowdowns for a quarter or two. I think that's going to be part of any business, any economy. Every economy is going to go through some ups and downs. But I think we have a clear path which has been put ahead of us by our Honorable Prime Minister, the Viksit Bharat roadmap, 2047.
Yes.
And at least we as a business, we are pretty much focused on that path. We are very clear that we want to grow. We want to grow in the spaces that we have created for ourselves, and we don't see any problem in growing. We may have a few quarters of bad growth,
yes,
but that's part of the game.
Well, that's right. If that's part of the game, that's good news. And on the domestic front, you're not seeming worried at all. But what about on the global front? Do you think, these supply issues, there are parts of the globe, Europe and various other parts that are going through a slowdown? How do you see that shaping up?
Europe is going through a slowdown, Germany more so. But I think it also throws a new opportunity for Indian manufacturers. because I see I have a lot of close friends in businesses in Europe. I see many of them now thinking in their boards of shifting businesses out of Europe and moving them to other countries in Asia. So I think this is an opportunity for us. If we play our cards right, a lot of that will come to India, because other countries like Vietnam or Malaysia don't have capacity anymore. They've run out of manpower.
Right.
And we have a lot of capacity. We have manpower, we have technology, we have states that are hungry to bring businesses in, to set them up. So I think we can convert this problem into a big opportunity, and that's what we should be doing.
Well, I love the optimism, sir, that you always bring. I'm asking you about a slowdown out there. You're saying there's an opportunity for us. And that's the way Indian entrepreneurs as well, that's the kind of pedigree they're made up of. But final question before I let you go. You'll raise some money via the QIP route. The street wants to know, what is Mr. Kalyani going to be using this money for? Please give us a brief insight.
First of all, large part of that money is going to go for our expansion. We are doing some M&A, so some money is going to go in that, some money is going to go into capacities that we want to create, and some money is going to go into reduce our debt globally. And just keep our balance sheet strong and healthy.
Well, I need to quiz you one more question. What about that M&A opportunity? How soon should we hear about it? Because you've got the watches now, the ammunition is with you, and you're set to fire. How soon do we hear about this M&A opportunity? And is the target company, is it domestic or is it international?
No. We are focusing on domestic companies first, because we see much higher growth opportunities in the Indian market. I mean, if the Indian market is going to go from 4 trillion to 20 trillion or 25 or whatever that number is, there's no place in the world that's growing at that space. Okay? So the growth is here. So the opportunities are here.
All right, that's an interesting conversation with Baba Kalyani of Bharat Forge, and more excerpts and snippets out of that event, mega event, which of course happened on a Saturday over the weekend. That is IBLA. Well, 50 points lower on the Nifty, 24,630 is where we are at. So there is a little bit of pressure. The star of the last 1 hour, of course, is CE Info. 16% higher is essentially where it will close. And I think almost all of the move came in the last... basically, it started at 240 when the news came. Stock was at 1650 and it ends at 1900 bucks. So that is a large move on, it's not a, it's a small cap name, but it has done well. The disappointment for today, of course, is the Nifty FMCG index, which ends with a cut of about 2%, 2.15%. For the Nifty and the Nifty Bank, there wasn't very much. We end flat to slightly sideways. Of course, mid-caps did much better, and the small-cap index also closed behind. So broader markets outperforming what the large caps did today. Guys.
Okay, let's look at some of the names in the mid-cap index and on the mid-cap screen. So today has been a good day for a couple of these apparel and textile stocks. Trident, for instance, 10.5% higher. Indocount, 15% higher. It was a good day for Gokuldas Exports as well. That stock's been up and about as well. In Enviro Infra, recent listing 11% up. Then you have slightly smaller names, moving higher. Flair Writing 10% on that stock. Not that we usually look at it. CEAT, of course, has been the stock of the day, but of course it lost half of the gains. It was up 15% at one point in time. Now it's ending the day with about a 7% gain. So these are some of the major movers and shakers on the upside. In terms of the volumes charts, names included JK Tyre. There was Lemon Tree, about 3% up. Sale, Manappuram Finance, Nalco. These were some of the key winners of the day. Zomato has had a sort of quieter session, and a couple of names like Ashok Leyland also losing out. The CV numbers, the retail numbers looking quite bad for the month of November. So that's the story. About 0.5% up on the mid-cap index, but the Nifty cooling off by 0.25% today.
Okay, with that, it's a wrap and closing bell. Don't go anywhere. Markets Forward is up next.
The Disruptor of the Year award highlights innovations that reshape how businesses operate and how consumers engage with them. Now, this year, the award goes to Blinkit, requesting Mr. Albinder Dhinsa, co-founder of Blinkit, to join us on stage.
Congratulations to Team Blinkit.